Welcome back to The Explainer, everyone. Today, we're unpacking something absolutely fascinating. It's a research paper by Yijia Xiao and their colleagues, and it's called Trading Agents, Multi-Agents LLM Financial Trading Framework. Look, if you follow the intersection of artificial intelligence and finance, you are in for a serious treat. We're looking at a massive shift in how AI handles the markets. We are moving away from solitary, lone wolf algorithms to these dynamic, highly structured societies of AI. We're talking about a fundamental rethink of algorithmic trading that completely changes the paradigm.
Okay, let's dive into this. What happens when AI stops trading alone and starts running an entire firm? Just imagine a traditional Wall Street floor. But instead of human brokers and analysts shouting across the desks, it's a super sophisticated network of large language models, or LLMs, debating, analyzing, and executing trades together in real time. Well, that's exactly the future this new research paper proposes and tests. It challenges this old assumption that quantitative trading requires a single monolithic superbrain, and instead it distributes all that cognitive load across multiple specialized models. So here is our roadmap for today. First, AI on Wall Street. Second, meet the Trading Agents framework. Third, the virtual trading floor. Fourth, debate and decision-making. And finally, fifth, performance and results.
Let's start with part 1, AI on Wall Street, the status quo.
Right now, in the financial sector, efforts have largely focused on single-agent systems, handling very specific tasks, or maybe multi-agent frameworks that just independently gather data without actually talking to each other. The researchers point out a massive gap here. These legacy isolated systems suffer from total tunnel vision, and they fail to self-correct. When a single LLM attempts to analyze complex market signals on its own, it's highly prone to hallucination loops, or just getting anchored to a specific bias. These independent agents basically fail to replicate the collaborative back-and-forth friction of real-world trading, where ideas are pitched, challenged, and refined. Well, the Trading Agents framework completely flips the script. It creates a collaborative, dynamic firm of AIs that interact constantly, effectively breaking those hallucination loops through peer review. Which brings us to part 2. Meet the Trading Agents framework, the innovation. So what is it? Trading Agents is a novel stock trading framework entirely inspired by human trading firms. Instead of one monolithic AI trying to process every single piece of market data simultaneously, it features multiple LLM-powered agents assigned to highly specialized roles. The methodology here relies on outfitting each LLM with a specific cognitive architecture. By utilizing targeted system prompts and distinct context windows, the researchers effectively constrain each agent to focus only on its unique domain. It's specifically built to simulate real-world collaborative dynamics. The system leverages the distinct skills of these specialized LLMs, forcing them to work together toward one common goal, maximizing alpha and mitigating risk. Moving on to part 3, the virtual trading floor, the cast of characters.
Let's meet the team. We've got fundamental analysts digging into the core financial health, earnings reports, and macroeconomic indicators. We've got sentiment analysts processing news feeds and social media to literally read the market's mood. Technical analysts are running the quantitative data, evaluating price action and momentum signals. Then we have the traders themselves, and they are equipped with varied risk profiles. Some are programmed to be super aggressive, others conservative, perfectly mirroring the diversity you'd see on a human prop desk. And finally, overseeing all of it, a risk management team continuously calculating the firm's total market exposure. Every single one of these roles is operated by an isolated LLM instance, fully immersed in its specific persona. It's wild.
All right, part 4, debate and decision-making, how it works. The framework purposefully engineers internal friction to find the truth. Within the research team, you have a bull researcher agent and a bear researcher agent. The bull is actively assessing market conditions for upside potential and growth catalysts. Meanwhile, the bear is actively probing for the downside and hidden structural risks. These LLMs are forced into a multi-turn dialogue where they actually have to explicitly counter the other's data points. This creates a mathematically rigorous stress test. By forcing opposing perspectives to collide over several iterations, the system ensures that it isn't just blindly following a momentum trend. The debate forces the agents to justify their thesis, which surfaces edge cases that a single agent would completely ignore. Let's walk through this pipeline from start to finish. Step 1. The researchers are bull and bear execute their multi-turn debate, analyzing the market from completely opposite ends to generate a beautifully balanced thesis. Step 2. While this is happening, the risk management team is constantly monitoring the broader portfolio to ensure the firm isn't getting overleveraged. Step 3. A specialized manager agent steps in. This manager agent evaluates the outputs from the bull and bear debates, contextualizes it with the risk management team's parameters, and synthesizes the insights into a cohesive strategy for the traders. Finally, step 4, an informed, multi-layered trading decision is executed. It is a highly structured simulation of a dynamic, collaborative environment. Which brings us to our final section, Part 5, Performance and Results, the bottom line. So does it actually work? Well, the extensive experiments completely prove the efficacy of this architecture. When tested against standard single-agent baselines and traditional quantitative models, the TradingAgents framework didn't just show a minor bump. No, it delivered a significant, persistent increase in cumulative returns across multiple market regimes. Furthermore, it achieved a notable improvement in the Sharpe ratio and safely reduced the maximum drawdown. By relying on a society of agents rather than just one single oracle, the framework actively mitigates tail risk while still capturing the upside. The data proves it. This multi-agent debate and specialized synthesis directly translates to superior, risk-adjusted outperformance.
I love how the authors state their conclusion here. Quote, "Detailed architecture and extensive experiments reveal its superiority over baseline models, highlighting the potential of multi-agent LLM frameworks in financial trading." End quote. This isn't just a minor, incremental update to trading algorithms, folks. It's a massive structural leap forward. It proves that cognitive diversity, even artificial cognitive diversity, just yields better alpha. By letting LLMs specialize, collaborate, debate, and manage risk as a collective unit, they've created a resilient system that fundamentally outperforms isolated bots. For the broader industry, this suggests that the future of quant trading won't just be about having the fastest model, but having the best organized society of models.
So what happens when human trading floors are fully replicated by societies of LLMs? As these multi-agent frameworks become more complex, faster, and exponentially smarter, the very nature of financial markets could be transformed by digital firms that never sleep, constantly debating their way to the perfect trade. It is a true paradigm shift. I highly encourage you to go explore the source material to look at the deep technical architecture behind these agents yourself. Thank you so much for joining me for this explainer. Keep learning, and I will see you next time.